Welcome to Trading Reality. Today's article, Execution is the Strategy, or Why Your Best-Looking Fills Should Worry You the Most. Most trading strategies do not fail because of signal quality. They fail because execution is treated as an implementation detail. I want to show you how true that is, not by listing everything that can go wrong, but by pointing to the few things that consistently matter. When I was hired as an execution specialist at a multi-billion-dollar hedge fund, I used to sit, politely, patiently, through meetings and presentations from quants and portfolio managers. It would quite often play out the same way. They would present their stellar performance charts, methods, equations, marketing references, everything you would expect. These were serious people, Ivy League PhDs, experienced PMs, people who had clearly put in the work. At some point, I would ask a simple question. May I ask what the execution assumptions were? Almost without fail, something would shift in the room. We don't care about execution. We have average holding times of 2 full days and above. You could hear the resounding irritation. So I learned not to push it in the room. I would wait for the meeting to finish, then ask for a private conversation. Same question, this time without the audience. Polite, dry, gather the data. Then I would go back, collate the information, and do the work. Sit there, shut everything else out, run the analysis properly, knowing already that this might not go well. I had my intuition and my internal statistics. Then another private conversation, because the result was rarely subtle. Sharpe ratios north of 4 would drop to around 1.2 under optimistic assumptions. Under more conservative ones, the strategy would simply bleed. The clearest case I remember was a cross-asset carry, EUR pegged. And it was very much not the only one. And this was not high-frequency trading, but multi-day holding periods, highly liquid instruments, top-tier market access, competitive commissions. And still, execution didn't just adjust the result, it rewrote it. Most symptomatic trading strategies follow a familiar path: signal discovery, backtesting, deployment. Execution is either assumed, simplified, or treated as neutral. This is where things start to break. Slippage, if it is considered at all, is often treated as a fixed adjustment, a number, a parameter. But it is not. It is a variable, context-dependent, state-dependent, and this leads to the first structural trap. Trap number 1, the better the signal, the harder it is to execute consistently. There is a counterintuitive truth about fills that most people miss. A good trade is contested. Informed traders on the other side of a real edge will not let you in cheaply. A bad trade is often uncontested. The book gives way, slippage is small, you fill at touch, which means cheap, easy fills should make you question your signal. Slipped, partial fills, adverse selection, the things that feel like the market punishing you, are often the market confirming that something is actually there. There is structural reinforcement of the same effect. Strong signals also tend to appear in transitional regimes. News, dislocations, crowded trajectory, crowded inventory, where spreads widen and execution gets worse for everyone. But the cleaner version of that trap is simply that good fills correlate with poor trade quality. What is assumed to be independent, signal and execution, is not. They interact, and that interaction is rarely in your favor. This is the first of several traps I'll be talking about. Subsequent posts will cover risk layer distortion, the market selection trap, and the one nobody wants to hear about, the cost of being right. An experienced trader will place an emphasis on risk. But if execution assumptions are wrong, the entire risk layer is distorted. Entry is not where you think it is. Exit is not where you think it is. Drawdowns are not what you modeled. The problem is not just execution adds cost. It's that it quietly reshapes your risk profile, sometimes hurting you, and sometimes by helping you for the wrong reasons. Here is a real one. A single tick of slippage caused a missed exit. The position stayed on. The next entry, one that should never have fired if the exit had triggered correctly, missed a big winner. The rest you can imagine. Double the drawdown, strategy abandoned, and my post-humorous analysis revealing the real drift. This happened not to one, but to a dozen different trading systems I was tasked with overseeing. So as a trader, you need to be ready, firm, and honest. Execution is much more than most people think. It is not just slippage. It is not just the trading platform. It is the market you choose, the venue, the latency, the commissions, the placement, the size of the order, the available liquidity, the competition for the same trade. In one word, reality. Take trading gold as a useful example, because it sounds like a single thing, and it isn't. Gold futures, micro futures, OTC, CFD products, each has a different book, a different liquidity profile, a different microstructure, and even different price behavior. They are not interchangeable, and execution is where that difference shows up first, usually painfully, and usually after you've already committed. Execution is unsexy. It's often treated like the last administrative step, the final turn before you get your license to trade. But it's not a formality. It's a traffic light. It should tell you green, yellow, or red. And in practice, it should very often tell you no. That no is not a failure. It's information. Execution is market selection. It's cost. It's timing. It is not a layer on top of the strategy. It is part of the strategy. It feeds directly into risk. It operates at the level of micro, even nano level details. And those details accumulate. If you have a great strategy, you may have signal. You may even be 10 to 40% of the way there, depending on what you're doing. But that's not the end. And it shouldn't feel like the end. A red light from execution is often the most valuable answer you can get. It means either you are onto something real, but not yet implementable, or you have been disciplined enough to hit a wall before carving a hole in your wallet. Years later, I still think back to those private conversations after the meetings, the walk back to the desk, the dry presentation of numbers that nobody asked for, a Sharpe of 4 becoming a Sharpe of 1.2, then sometimes a flat line. Without execution, a strategy is just a thesis. With execution, it becomes either a position or a lesson. Execution is not downstream of the strategy. It is where the strategy actually becomes real. Thank you for joining us on Trading Reality. We release a new episode with every article we release on Substack. Please join us on Substack at Trading Reality, and remember to subscribe to our YouTube channel.